Hi everyone. Let's work through this overhead variance demonstration, and it's taken from exercise 1125, which involves a computation of some overhead variances. Okay, in this problem we're dealing with the Starlight Glassware Company, and they give us some information about some standards in their flexible budget data. The standard variable overhead rate is $18 per direct labor hour. And the quantity of direct labor, it takes 2 hours to make 1 unit of output. They have a planned budgeted fixed overhead of $300,000, and they expect to make $25,000 units. Okay, then we look at February and we see what really happened. They made 20,000 units, not 25,000. The actual variable portion of overhead that was incurred was 960,000. The fixed overhead fell a little bit short of the budgeted amount at 291,000, and the actual direct labor they used was 50,000 hours. Okay, now using what we know about variance formulas, we're going to solve the 4 requirements below. So the first requirement asks us to compute the variable overhead spending variance. Okay, I'm going to abbreviate. And what is that going to be equal to? Well, it should be equal to, let's take the actual variable overhead. Okay, and the actual variable overhead, let me abbreviate that a little bit better, is going to be, was that 960,000? Okay, and as always, let me format that a little bit better. Alright, then we need to also consider something called the actual hours, right, times the standard variable overhead rate, and that was given as $18. So let's just call that the standard, and it's the variable overhead rate. VHD rate, there we go. Okay, and I'll underline that. And I know that bleeds over a little bit, but let's put it right here. And we'll put in that formula. So that is equal to the 50,000 hours, direct labor hours, times the standard of $18. Okay, so we have $900,000. Now, when we compare that actual, that 960, to that standard amount, we come up with the variance. So why don't we put the solution somewhere in the middle, right here, and we'll say we take the actual less the standard, and it's 60,000. Since the actual was higher than the standard, that's unfavorable. So that takes care of part 1. Now let's look at part 2. And of course, that and that and that should be in dollars. Okay? Let's look at number 2. Compute the variable overhead efficiency variance. So let me copy from here to save some time. And we'll just change this word and make that efficiency. Okay. Now, one way to calculate this is to take the standard variable rate times the difference in hours, right? So in this case, let's put the standard variable rate here. We'll put that right in this cell again, and we know that's $18, right? And then over here, let's put the actual hours actual hours less the standard hours. So what we're trying to compute is what's the variance in hours. And now let's just center that over these three cells. In fact, I think what I'll do is put this here and then just center it that way. Okay. And then what we'll do is we'll put that in. Well, the actual hours were 50,000 given in the problem, and the standard hours were 25,000. However, that was 25,000 based on the budgeted output. Now, the output was a little bit different. The output was actually 20,000 units, and we were allowed 2 hours per unit. So the flexible budget, if you will, for given the production we had, should be 20,000 times 2. Does everyone see that? Or 40,000? I'm talking about this term right here. So if we take the actual minus the standard, we really have a variance in hours of 10,000. Let me go over that again. 50,000 was actual, but the standard hours is not the 25,000 shown there because, not the 20,000 hours shown there, given that we were going to make 50,000, but since we only made 20,000 units, the standard becomes only 40,000 using for that level of output. Okay, so then what we need to do is we know that that is an unfavorable amount because the actual hours exceeds the standard. So I'm going to put a little u here. U usually means unfavorable. You'll see that used quite often. And let's compute the variance now. And I think I will put that right there. And we'll say it's equal to that, $18 times the number of units that we're off. And that also is an unfavorable amount. That's the answer to number 2. Okay, now let's tackle the third requirement. What's the fixed overhead budget variance? Well, this one is really, if you will, a straightforward calculation. We need to look at the actual fixed overhead and compare that to the to the budgeted fixed overhead. Get the little error. I'll ignore it. Okay, underline that for now. Just trying to get this somewhat formatted. I'm not paying a whole lot of attention to is it perfect formatting in Excel. Let me insert a row here so we have that a little bit clearer for us. Okay. Alright, so the actual fixed overhead that was incurred was $291,000. And the budgeted fixed overhead was the $300,000, right? Okay, so the variance there, I'll just copy from that cell. Oh, I see I got to add a 0, so let me write that difference down and change that to $300,000. And so we have now a $9,000 amount, but I'm going to change that sign. I'm going to say equal, in this case, the budgeted amount exceeded the fixed amount, so that is a favorable variance, and we would expect that. To some degree, we had less volume. Our determination of fixed cost is not set in stone. It is a best estimate in most cases. If it truly was fixed, the number wouldn't change at all, but what we find in practice is that we classify usually accounts as fixed or variable, and they don't behave in that way across the relative range perfectly. Okay, let's slide down to give us some room, and we'll tackle part 4. I'll slide in a minute here. Part 4 said, what's the fixed overhead volume variance? Okay, now let's slide to give ourselves some room here. Okay, well, to do that, we need to determine the budgeted fixed overhead and the applied fixed overhead. But we have to come up with the applied fixed overhead first. What is the applied fixed overhead? Applied fixed overhead is going to be equal predetermined overhead rate times the standard allowed hours. Okay, let's tackle the predetermined overhead rate portion first. Let me set an equal sign here so that we know what we're looking at. Okay, the predetermined overhead rate is going to be equal to $300,000 of budgeted fixed overhead, given above in the problem, divided by the number of hours allowed for the production we expected. That's how you would determine a predetermined overhead rate. So we expected to make 25,000 units, right? And it was going to take 2 hours per unit. So that's this section of the term. The end result is we've derived a $6 applied overhead rate per unit produced. And that was, if you will, the standard applied amount for the budgeted level of activity. Now we have to multiply that times the standard allowed hours. And let me just fix that abbreviation so that looks a little bit better. Okay, so to determine the standard allowed hours, we need to take the 20,000 hours, the 20,000 units we actually produced, shown right there in the problem, times the 2 hours per unit, which says the standard allowed hours should have been 40,000. So to come up with the fixed overhead volume variance, we just take that predetermined overhead rate times the standard allowed hours, and we come up with $240,000, which is the answer. And that is our applied fixed overhead. Now we need to determine the fixed overhead volume variance, and that's going to be equal the budgeted fixed overhead. You want to find the difference, so we'll subtract out the applied fixed overhead. Okay, let me create a new row or two here. Okay, so the budgeted, let's put the budgeted portion right here. Again, I'll use the equal sign to sort of line up where we are. Well, the budgeted portion came from the problem, the 300,000, right? And the applied comes from what we solved below, 240,000. I'll slide this again. And our answer here then is going to be equal to 300,000 less the 240,000. Now some people would say this is favorable. That's sort of a matter of opinion. Output was different than what we would expected. Calling it favorable may not be the best interpretation. What we may want to call this instead as just call it as a positive variance. Because favorable this is not really something you should control. If the market forces dictate that volume was down, you would expect to have a difference in the fixed overhead budget variance, but it's certainly not a controllable item. In theory, it's fixed. Okay, let's bold the answers we were looking for on this problem. So now you have them all in front of you, although I understand you can't see them all on the screen at once. Okay? So hopefully everyone, you found this to be beneficial to your understanding. Thank you.